Hello everyone, welcome to the PwC Tax Bite podcast series. My name is Pieter Dree and I'm very happy that I can host today two experts in the field of transfer pricing to talk about the amount B. Let me first introduce the persons I have with me in my virtual recording studio. First of all, I have Gilles Fransens with me. Gilles is a member of our team focusing on business models and in that capacity working with multiple clients on the OECD Pillar project. And also with me is Stefan de Baat. Stefan is a senior counsel in our team. He doesn't need any further introduction, I would say, because he's a regular guest to my podcast series. So welcome, Gilles and Stefan. Gilles, let me start with a question for you. We're going to talk about the amount B of the Pillar project. Why is amount B relevant? Why are we talking about that today?
Yeah, thanks, Peter. And maybe let me just start by taking a step back. So I guess most of your listeners, Peter, they will be fairly familiar with Pillar 2, so the global minimum tax. Amount B actually is part of the Pillar 1 project, so the other pillar in the OECD project, where Pillar 1, the focus of that one is really to focus on the reallocation of taxing rights. In Pillar 1, we have an amount A and an amount B. Amount A, we had a progress report which was released over the summer, and I think that was also, we covered that one in one of the podcast episodes as well. So I won't go into much detail on that one. But now we have a consultation document on amount B. And for most of your listeners will probably know this, but for amount A, the scope limitation was 20 billion in revenues and a 10% profit margin. So the scope of amount A was fairly limited in terms of which companies it would apply to. This is very different for amount B. There is no such scope limitation, so it could, in principle, apply to all multinationals. So that makes it fairly impactful, I'd say, to have a discussion on that one. So at a high level, amount B is aimed to be a simplification mechanism, to structure how to remunerate, what is defined as baseline distribution activities. So basically set a standardized mechanism to remunerate these baseline distribution activities. And what the amount B focuses on are really the buy-sell distribution activities. So where you have a local entity that buys goods from a related party, for example, a manufacturer in the group, and it sells those products then to third-party clients. The discussion draft on amount B, it also considers sales activities which are set up as an agent or commissionaire rather than buy-sell. So the scope could be, broader, but still very much focused on that sales context of the value chain. For me, amount B is fairly important development to monitor for two reasons. So the first reason is the compliance burden. So while the ambition of the project is to increase simplicity, it does seem to be going into the direction that it will actually make everything a bit more complex, a bit similar to what we've seen with Pillar 2 as well. So that's, I think, one important reason companies should be following this one. The second reason is broader tax model concerns. So amount B does have the potential to increase the cases of double taxation, and in my opinion, that's especially the case in very high or very low margin industries. So if we take the example of a low margin industry, so where as an aggregate group, say you have you earn an operating margin of 2%, and let's now assume that per the framework of amount B, you would have to give 3% away to your distribution activities. Well, that means you have to give away more to the distribution activities than the amount of profit you have as a group. So that's I think a big concern there. On the other hand, for higher margin industries, in many cases, in those industries, distribution type of activities already have fairly high profit margins. If under an amount B model, that profit margin would go down, there would be an incentive for governments to try and argue that amount B isn't appropriate in order to, claw back or gain access to a bigger share of the overall profit from the group. So that a bit in a nutshell, Peter, as some context and some views from my side on why this is an important development.
Yeah, thanks, Jules. So, yeah, indeed, with all the attention for Pillar 1 for the larger companies, Pillar 2, one would forget that there is also this amount B, basically impacting everyone in potentially very significant manner. So, indeed, very good that we have this topic in the podcast today. Stefan, the trigger for having the podcast is also that we have the discussion draft now. What's in there in that document? What's you ran through it? So what can you share about that with us?
Thank you, Peter. Thank you, Jill, and good day to all of you. Yes, indeed. So last Thursday, the OECD published this discussion draft. I can stress that it is still a secretariat paper, so there is no consensus by the inclusive framework. It wants to achieve, as Gilles has been saying, a meaningful streamlining and simplification for baseline marketing and distribution activities. Further, they indicate this is in line with the arm's length principle and also must address the needs of low-capacity jurisdictions, which is another name for developing economies. They also want to achieve a trade-off between reliability, accuracy, and administrability. So they really want to go for that simplification. So basically, it's about baseline marketing and distribution, but still relies heavily on the OECD transfer pricing guidelines. As some example, the references to the accurate delineation of the transaction is all through the document. You can see it all through the documents. They rely on the risk assessment, the risk analysis in the transfer pricing guidelines. So this is perhaps a first concern for low capacity jurisdictions, whether they can actually assess this risk quality approach. As Jill has been saying, this is in principle applicable to all MNEs. So the threshold of amount A does not, and it is repeated in the document, does not constitute an element of this discussion draft. One element also to discuss is the approach that they will take, because this will also, or it is at least aimed to increase certainty, whether it will be under a safe harbor approach or whether it will be a rebuttable approach, but that is still under discussion. So a lot of these elements are still under discussion, as it is only a secretariat document. With regard to the time frame, they indicate that amount B will be finalized by mid-2023 with expected application or implementation as from 2024. With regard to the format, whether it will be included in the OECD transfer pricing guidelines or whether it's on another format like a treaty or inserted in a multilateral instrument, that also has not yet been decided. And going through the documents, you can see four main sections in the discussion draft. That is one on scope, one on the method to be used or the methodology to be used, one section on documentation, and finally a last section on tax certainty.
Okay, thanks, Stefan. So 4 sections. Let's start with the first one, the scope. What can you tell us about that?
Yeah, thanks, Peter. As Jill has already indicated, I mean, the primary scope is with regard to buy-sell arrangement, where the tested party purchases goods from one or more associated enterprises in one jurisdiction for wholesale distribution in the other local market. So that is actually the main point. So this buy-sell arrangement. Now, one of the discussion points that is going on and where the OECD Inclusive Framework asks for comments, asks for the views of stakeholders, is whether this scope would be extended to sales agencies and commissionaires arrangements. So this is where the tested party actually contributes to wholesale distributions of goods or other elements for a related party to the extent they exhibit economically relevant characteristics similar to those outlined as buy-sell arrangement. This is one of the criticisms, or at least some of the elements that came forward, was that sales agencies and commissionaires arrangements, they very much resemble buy-sell arrangements. So we think they should, or other countries say they should not be included into this scope. There are some 12 scoping criteria, so this is quite a lot based on qualitative and quantitative criteria, and they should be based on established facts and circumstances. And one of these elements is, but again, there is no consensus in this one, should there or should there not be a written contract? And what should be the content of that written contract? The second element is to distribute primarily, or the distributor should primarily distribute in its market of residence. So with only a limited number, limited threshold with regard to sales in other resident, in the non-resident state. Most of the criteria are, I would say, negative criteria. So meaning that if you fulfill these criteria, then you are actually out of scope. So what is excluded already from the scope is manufacturing activities, research and development activities, procurement activities, financing activities. You should not perform risk control functions. So hence the analysis again of the risk control framework. You should not undertake activities that relate to create or obtaining the rights to distribute in a market when those rights itself would be remunerated already at arm's length. So this leads to intangibles. So no valuable intangibles should be maintained. No technical or specialized services should be performed. Not perform strategic sales and marketing activities, because this could again lead to the generation of unique and valuable intangible assets. So no sales to customers over a certain percentage. That is, if you only have one major client exceeding that threshold, it would also be out of scope. A certain threshold with regard to operating expenses and net sales. Again, not assuming significant economic risk. We come back to the risk framework there, the risk analysis. Intangible assets are included. BAPAs, so bilateral advanced pricing arrangement, multilateral advanced pricing arrangements, they will prevail over amount B, so they would also be out of scope. And an important one is with regards to commodities or non-tangible goods, where there is no consensus yet whether they should be included or not be included in the amount B scope. So there are several specific questions with regards to scope to the commentators, in particular whether sales agents and commissionaires would be in scope, the product-based exclusions, for example, digital goods, commodities, would be included, whether you would need local market comparables or how they should be included in the scope, and what about multifunction entities? Should they also be in scope, or would it be carved out of the scope? So scope, or the scoping exercise, is really a very important exercise in this discussion draft.
Okay, thanks, Stefan. Yeah, I can see that, of course, scoping. I think the second issue that was discussed in the document was the methodology. Is it correct that the document presumes the use of TNMM as a standard methodology?
Thanks, Peter. It certainly has a predominant place in the discussion in the discussion draft, and the TNMM is referred to multiple places, and also profit indicators like return on sales, barrier ratio, return on sales with possibly a barrier ratio as a floor and a cap, return on assets. They are all mentioned, and these are all TNMM methodologies. But again, there is no final conclusion in the document, because one of the discussion goes also, what if you have local comparables? then should you go perhaps for another method, the most appropriate method, for example, a CUP or comparable uncontrolled price method? What with regard to other potential methodologies that are available? So there are specific questions to commentators on the methods and the profit level indicators that is used. But indeed, the TNMM has a predominant place in the discussion draft. On how they would move forward is, at least they suggest two ways of moving forward. One, with regard to methodology, is a matrix approach, where you would kind of conceive, based upon the methodology, for example, TNMM return on sales, where you would scope or put in scope several factors like industry, geographic elements, similar markets, and these kind of elements. And then you would kind of come to certain ranges within that matrix, and then you have to pinpoint within the matrix your, I would say, your most appropriate point of return. That's the matrix approach. Another approach would be a mechanical solution, where you go into a more formulaic approach, where you would say this is the range, and if you're in there, okay, you're fine. If they're out there, well, then there would be a correction. But then you come into the precise kind of issues that Jill reflected upon. There is also, or at least the discussion drafts also addresses common benchmarking search criteria in order to, I would say, introduce a kind of standardized process on how to come to an agreeable comparable set. And this then would underpin the amount B pricing solution. But as the discussion draft indicates, further work is still needed, for example, on comparability adjustments as well. Whether comparability adjustments are needed, think about inventory corrections, think about receivables, about payables. And if they are needed, which ones, but also there is no consensus whether comparability adjustments are needed or not. Countries have divergent views on the need of comparability adjustments, and also on the matrix or the more mechanical solution. There is still a lot of discussion going on in the inclusive framework, and that's also where comments from stakeholders are requested.
Okay, so still a lot to be discussed and looked into for the methodology. The third layer was documentation. We already have quite a lot of documentation in the transfer pricing world: CBCR, master file, local file. Is the document suggesting another layer of documentation, Stefan?
Well, it looks like it and it doesn't look like it. The good news is that the information request is aligned with the local form. So that's one thing. But on the other hand, they say that they want robust and comprehensive documentation, as it constitutes an essential element of amount B. So we can indeed expect another layer of documentation. It builds on chapter 5 of the transfer pricing guidelines guidance. So with regard to master file and local file, that's a good thing. But additional information, this is the other layer, specific to amount B, could be included precisely into that local file. And they go on with regard to something like 2 pages of documentation that could be useful. For example, a statement that the information on compliance with regard to amount B is true, accurate, and complete. Okay, that's not the most, I would say, the kind of statement that requires the most work. But then we come to other elements. For example, delineation of the baseline marketing and distribution activities. They want financial information by key customers, sales to associated and third-party customers, so segregation there, per product, per jurisdictions, sales to end customers and to wholesalers, retailers. So you see already some kind of detail coming in there. They want to view commercial and financial relations with other group members that could influence amount B. They want to see annual accounts of the tested party if it is not the taxpayer. They would like to see how the amount B methodology links in with the controlled transaction and its results. They want to see also written contracts, as I already indicated at the start of this podcast, on whether there would be a need for written contracts or not. And this written contract, what they do in the discussion draft is already indicate what should be into the written contract. For example, the nature of the distribution agreement, whether it's exclusive or non-exclusive, geographical territories, the description of responsibilities, information to be produced, performance metrics, and all this like. So there's something like 10 or 12 elements that they want to have included into that contract. You could ask your questions, what about the freedom of conclusion of contracts? But these are the elements that they want to see into this contract. And also they want to see copies of unilateral advanced pricing arrangement or of bilateral or multilateral advanced pricing arrangement. What the discussion draft also indicates is that tax authorities should refrain from requesting to the taxpayer to produce or submit information or that is already in the hands of tax authority or administrations, or to submit it in a different format. But this is also already guidance that comes from the transfer pricing guidelines. So indeed, there may be another layer of information coming onto us.
Yeah, that always scares me a little bit, Stefan, that with new rules, new documentation, new burden comes. And what is also often the result of new rules is the risk of double taxation and tax uncertainty. You mentioned the fourth block to be about tax certainty. I'm really curious what the document is saying on resolving double taxation and the suggested approach on that.
Yeah, thanks, Peter. And here again, the reference is a lot to the OECD transfer pricing guidelines. And we have seen the increased documentation burden. We have seen a lot of, I would say, uncertainty for now with regard to scope and the methodology that is going to be used. What the discussion draft indicates is that the documentation package, together with a methodology that is, I would say, going to be implemented, will help reaching a common understanding between the tax authorities. So that's good. That's good. That's good news, I would say. But on the other hand, if you look at on how the scoping needs to be addressed, on how the methodology needs to be addressed, I think there's also quite some room for creating tax uncertainty if the jurisdictions fail to reach that common understanding. So with regard to dispute prevention, references are made to advanced pricing arrangement, that is not something new. And with regard to dispute resolution, references are made to the existing frameworks, for example, the mutual agreement procedure, or if the double tax treaty provides it, also arbitration. So there is a reference to a multilateral solution, because you can think that this approach would also find its application in a multilateral way. That is that if the double tax treaty, or if all jurisdictions concerned have a double tax treaty along the lines of Article 25, that is then that, okay, you could find a multilateral solution. But again, this is not something new. So with regard to tax certainty, I would say that the discussion draft puts a lot of leverage on the existing mechanisms.
Okay, thanks, Stefan, for that very nice overview of the document and the contents with scope, methodology, documentation, and now also tax certainty. Yeah, quite a lot of question marks remain. At least there's an ability to provide input as well. So, Gilles, when you have been listening to Stefan, the summary here, what would you say are the key takeaways that the audience should take away from this?
Yeah, so for me, there's three important takeaways here. So the first one for me is, well, the objective of Amount B was to increase simplicity for taxpayers and tax administrations. So I think the direction we're going means that that goal will likely not be met, and it will actually lead to more complexity rather than an increase in simplicity. What I think might happen is that you sort of shift the work which companies and tax authorities have to do from the sort of more economic benchmarking analysis to, in an Amount B context, the more qualitative analysis around whether certain activities qualify for Amount B or not. On balance, though, I think the total workload will increase rather than decrease. So that's my first takeaway here. The second one is that the document looks like a real discussion draft. So If you look at the questions which are presented in the document, but also if you listened to the webcast of the OECD, it does really seem to be the case that the OECD is really looking for input from the broader business community to help steer the direction of this piece of work. And I do believe that this is a real opportunity for companies to provide input either individually or through industry bodies. And then the third takeaway for me is that we shouldn't underestimate the potential impact of Amount B, especially in case of an implementation through the OECD guidelines. This could mean that these rules would have fairly immediate effect in many countries. And for me, that does mean that it will be fairly important for all groups, because there is no scope limitation based on sites. So for all groups to continue monitoring how this Amount B work shapes up. And I'm sure, Peter, that there will be another podcast episode when we hit the next milestone on the Amount B project.
Well, thank you for that. And yeah, I would say with that, we are approaching the end of the podcast. Stefan, is there anything you want to add to the takeaways that you formulated here for the audience?
Thanks, Peter, and thank you, Gilles. I fully concur with what Gilles has been saying. I very much welcome the simplicity and the streamlining idea that's in the discussion draft, and also the ability to share thoughts on the way of travel, the way of direction that the discussion draft is going. But indeed, it looks like even this simple approach looks more complex, I would say, than the traditional arm's length approach. So the question is, what does it actually solve? Not simplicity or not complexity. And also with regard to tax certainty, I think that the detail that they request on Amount B may lead to new disputes or controversy between tax authorities and between the taxpayers and the tax authorities. So let's wait and see. I think it's a good attempt, but whether they will reach the right result, that still remains to be seen.
Okay, well, thank you. I think these are very nice concluding words. I think in the next weeks and months to come, we'll definitely talk more about Amount B. Also in this podcast, if anything new comes along. So what I take away from this is, with all the attention that's going to Pillar 1 Amount A and then Pillar 2, let's not forget about the very important impact this will have for a very broad range of businesses. So with that, Gilles and Stefan, thank you very much for joining me in this podcast. And I'm looking forward to have you on another one. And for the audience, thank you for tuning in, and hope to see you in the next episode.